This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Hello, and welcome back to everyone's favorite bank nerd podcast, Bank Nerd Corner. My name is Alex Johnson. I am the creator of Fintech Takes, and joining me, as always, is my co-host in this endeavor, the banking and fintech editor at Bank Director, Kiah Hazlitt. Kiah, good to see you. A happy post-Thanksgiving.
Yes, happy Thanksgiving to you. And it was great to see you last month in DC. Did you have a productive time in the Capitol?
I did. It was, I'm shocked actually how productive a time I have whenever I go to Washington, D.C. There's no shortage of fun meetings and great people to talk to. We were there for the American Fintech Council Policy Forum, which you did a wonderful job moderating our session and keeping everyone on track. So thank you for doing that. That was amazing. I really enjoyed sharing the stage with you.
No, that was fun. It's always great to take the group chat and put it on stage. And it was funny to me to be like, I'd love to talk more about what fintech bankruptcy courts could look like. And then should we set up a deposit program? Let's get some real stuff done now that we're in the Capitol. And we had to kind of stop having those conversations because we were about to run out of time. And there's just not enough time to debate what bankruptcy court would look like.
Yeah, I my experience generally the last couple of weeks has been like, this is great, but I need you to triple the amount of time I have to talk about this topic because I have way too much to say about this. I just did a webinar actually with Jason Mikula and some friends on credit building, and it was the same thing. There was only an hour, and there were like 5 of us. I was like, that's not enough time to talk about credit building. I need more time. We probably will feel the same way about needing even more time with today's topic and today's special guest. Kiah, would you mind introducing our returning guest? I think this is our first returning special guest to the Bank Nerd Corner podcast.
Yes. Joining us again is Julie Hill, who is now the Dean of the University of Wyoming College of Law. Julie, hi.
Hey, thanks for having me back. I didn't realize I was the first repeat. That's quite an honor.
Yes, this is, I think, probably the closest analogy, and this flatters my ego, so I'll go ahead and use it, is like you are the host for Saturday Night Live. And you know how they sort of count like the number of like return appearances you have on Saturday Night Live, and maybe it's Steve Martin who has the most. Someone has like the most, and it's like 15 or something. You're climbing up the rankings. You are now the first person to be a returning guest, so we're delighted to have you back. We, as anyone who listened to the last podcast that we did with Julie knows, Kiah and I were just frantically like taking notes and trying to get smarter as Julie was educating us on a bunch of topics. But there was one topic specifically that we touched on very briefly at the end, which was reputation risk. And Julie, this has been a deep focus of yours for a long time. You've written really great papers on it. You've done a lot of really wonderful research on the subject. And it's become much, much more relevant in the last week or so. And so I wanted to sort of give a quick overview of why we wanted to have you back on and sort of this topic that's popped up in Bank Nerd Corner circles. For those who haven't been obsessively on Twitter and on various podcast platforms over the last couple of weeks.
You.
And I commend you for doing that. If that's someone who's listening to this, like, well done. I sort of wish I had unplugged a little bit more over the holiday weekend, but Mark Andreessen of Andreessen Horowitz made an appearance on the Joe Rogan Experience podcast. And in that podcast, which in typical Joe Rogan fashion is like 3+ hours long, they covered a whole wide range of topics. But the reason it popped up on Bank and Fintech Nerd Twitter is because somewhere in the middle of that podcast, Mr. Andreessen went on quite I don't know if I'd call it a rant. I'm not sure what it was. I guess the whole thing was sort of like very high energy and a little bit conspiratorial at times. But he went on
the grievances.
The airing of the grievances. That's a good holiday way of putting it. Yes. He basically did a whole thing on debanking. And so for anyone who saw clips of this going around or listened to the whole podcast, essentially, what Mark Andreessen sort of alleged was that there has been a coordinated effort over the last 4 years in particular to sort of put political pressure on crypto companies, on fintech companies, on sort of disruptors within the financial services space. And while a lot of the specifics of the argument he made were pretty transparently not true or incorrect in pretty obvious ways to anyone who pays attention to this space, he did a whole thing on the CFPB and Elizabeth Warren and on politically exposed people and AML and a whole bunch of things that were sort of actually not that relevant to his point that he was trying to make. What he was really talking about was this trend that I think has become more prevalent or more discussed over the last 4 years of certain high-risk industries losing access to bank accounts or banking relationships. And I think given what his firm does, crypto was very central to that point. We obviously have seen other examples of this in firearms, oil and gas. We've seen it obviously in cannabis, which has this weird sort of semi-legal status in the US.
Mm-hmm.
So there's a whole bunch of different examples of this. The one component, though, that he didn't really talk about, but is actually very related to the larger point that I think he was making, was reputation risk. And so, Julie, we wanted to have you on to sort of maybe explore the part of that discussion that wasn't explored on the Joe Rogan Experience, but that you are certainly an expert on. Kiah, remind me maybe where we left off in our last conversation with Julie on reputation risk.
Yeah, so we mentioned reputation risk not because Julie wrote a really fantastic paper in 2019, but because one of the cases that she referenced in that paper appeared before the Supreme Court. And I can't remember exactly when we had discussed it, if the opinion had come out from the Supreme Court. And that case is Vulo versus, is it NRA? Yeah. And that case is went before the Supreme Court because there was a question about the constitutionality of speech, which is why the Supreme Court got to weigh in on it. But the facts of the case itself, the speech that is in question, was that the head of the New York bank regulator had noticed some insurance companies selling insurance products that were likely inappropriate or illegal. And so that's kind of beside the point. But then after maybe giving that feedback to these companies, the New York banking agency went further and began thinking about the financial institutions that provide banking services to the NRA. This was contextually in the wake of a school shooting, I believe maybe in 2016. Mm-hmm. And the NRA alleged that the regulator had discouraged the banks from providing these banking services. And the NRA said, you can't do that. And I believe that the argument from the New York DFS was that this is protected speech. This is, and then the question is this government speech? Are you speaking kind of as a citizen?
Well, look, the reason I think that the New York Division of Financial Services got into trouble here is because they issued a public statement that said that insurance companies and banks should carefully consider reputation risk when providing services to gun advocacy groups. And the industry, I think, pretty reasonably took that as a shot across all of their bows, right? Because it didn't say, don't do business with the NRA who might have been violating the law, or don't sell illegal insurance products. If they'd just done that, I think everybody would say, oh, well, they're just trying to follow the law. Instead, they specifically singled out gun advocacy groups. So it seemed like they were attacking potential customers based on their speech and or political beliefs. And so that's, I think, what precipitated the suit. And this is also what made people very concerned that debanking was going to happen, Because they said, look, the regulators aren't even being coy about it. They're telling us up front that they are going to force banks to cut off services based on political beliefs. Like, what more do you need? They said it. Yeah. And not only did they say it, then the governor of New York chimed in and said yes, and that these gun advocacy groups are terrible. So that's kind of how, and of course, then there's the legal wrangling kind of separate and apart from what bank nerds care about on the question of free speech. But this is, I think, one of the quintessential examples that there might be instances where bank regulators, whether those are state regulators or federal regulators, take action against banks or threaten action against banks to get banks to stop doing business with customers that they don't like.
So that's perfect. So a question just on like putting a bow on this specific example, what was the outcome when it went to the Supreme Court?
Well, so they say that the regulator shouldn't be using their speech to limit other speech like that. That's sort of, but I should probably say that constitutional law professors are their whole own breed, and they do not take kindly to banking law professors weighing in on the First Amendment. So,
totally fair.
But I mean, I think for bank nerds, the takeaway from this is not that there's any hard and fast rules on reputation risk itself, right?
Right. The case before the court was not about reputation risk, but there was a point in the arguments where I believe Sotomayor, she said basically like reputation risk if it exists. And that for me was a moment where I stopped and I was like, does reputation risk exist? And when you come up in banking, especially come up in banking post-financial crisis, right? This was a period of time where, the financial crisis, people blamed the banks. The reputation of the industry was bad. And then there was a series of financial reforms tied to the Dodd-Frank Act to kind of shore up faith or belief or reputation. And then, Julie, in your paper, you mentioned examples like the Wells Fargo example, right? This was a time where the bank's reputation really suffered. And so when you are a post-financial crisis, finance reporter, reputation risk is in the air you breathe. You are told about it as a form of risk as real as credit risk. And so when I heard the justices say like reputation risk, if it exists, it really actually made me pause and think about the articulation of this risk and even I don't want to say the legitimacy, but like why who does determine reputation risk? What does reputation risk actually look like? And it was interesting to think about your paper, Regulating Bank Reputation Risk, which was published in 2019. And what would it look like to have that paper updated today for, how reputation risk is communicated or discussed in the industry from a supervisory perspective, right? Not when it goes before the Supreme Court, but what the interpersonal communication between regulators and banks, and then what are the outcomes of that? So I think that's why, we want to talk to you today, right now, in the context of maybe what are some of the outcomes tied to concerns around reputation risk.
So maybe just a minute on how we get to reputation risk as a legal concept. So bank regulators for a very long time have been tasked with supervising the safety and soundness of financial institutions. So for many, many years, the risks that bank regulators and supervisors focused on were credit risk, just the risk that bank customers don't pay back their loans and or the risk that payments processing sort of goes wrong. And also market risk. And market risk is just the risk that banks have due to fluctuations in interest rates. You don't want to wind up with long-term loans paying really low interest rates and then having to pay high interest rates on your deposit accounts. So bank regulators focused on those two risks for a very long time, and I think did a fairly decent job of keeping banks in safe and sound condition, with a few hiccups that we always have in banking that make bank reporters' lives more interesting. But in the 90s, folks started thinking about risk more broadly. And the first risk, I think, to really emerge was just a broad category that was deemed operational risk. So you think back to this time period, this was a time period when we were all worried that in the year 2000, our computers would stop working. Right? So
for the kids listening, this is called Y2K. Yeah, you can look it up.
Yeah, I mean, it's very old school now. But at one point in time, people were very concerned that banks would come to work on January 2nd and no computers would turn on and all the financial records might be lost. And so this was going to be a big risk to banks, and regulators were understandably concerned about that. And so as they started to think about, well, where is their operation risk? And are there more subsets of operation risk that we could talk about? This idea of reputation risk, that you do something and people don't like it and then they pull their money out or don't bank with you anymore, emerged, the idea of reputation risk. So it went from being not ever mentioned in any supervisory guidance or any examination manual or anything else to almost like overnight, there being hundreds of references to reputation risk in the bank examination manual.
Well, and I think something that I have to be reminded of is that, reputation actually really matters in banking. And I think about that even from maybe before regulators decided to add this as part of their, supervisory purview. It's not a coincidence that bank branches are very beautiful and stately and have big columns. It's not an accident that they've got, the big vault, even if they weren't really using that to store money, as money became more digital. There's a lot of telegraphing and messaging in banking. There's a lot of that comes out in like the names of banks and
the sponsorship of the local softball team. Yeah,
I mean, it comes up. It's why banking is seen as like a business formal, maybe industry where you would wear a suit, right? These are things that they're trying to telegraph as part of their role in the community. And so it's not something that banks hadn't thought about before regulators decided to have them have them incorporate it. It's just interesting to think about how this imaging, like how people think about us publicly as an industry has evolved over time, and then great financial crisis, and then Wells Fargo happened, the fake account scandal. So it's really, really interesting about how it gets incorporated and even put into some of the documents that inform regulators, right?
Yeah, and I think that in one sense, banks aren't that much different from other industries in that their reputation matters, right? Your local supermarket cares that you think that they have a good reputation for selling fresh produce. And the University of Wyoming cares a lot that it has a reputation for producing really terrific attorneys. So we all sort of care about our reputation.
Yeah.
The reason that we think that banks might be in a particularly precarious situation is that they are prone to runs and panics. So banks have these loans that are mostly long-term in duration, but they have deposit accounts that people can withdraw at any time. And we think that if those depositors all decide to withdraw their money, that even if the bank is very financially sound, that the withdrawal of money, the bank run, will cause the bank to fail. And then we think that run might spread to other banks, and then all of our banks fail, and that would be a very bad thing.
Right.
Now, of course, academics have spent lots and lots of time studying what actually causes bank runs, and there are lots of different theories among economists about that. But I think that is another part of the reason that regulators suddenly felt very empowered to talk about reputation risk. I think in the beginning, reputation risk was sort of thought of as an add-on. So Wells Fargo opens unauthorized accounts, and that's against the law. And so I think probably rightly, their regulators tell them, stop doing that. That's against the law, and it leads to reputation risk. But you'll notice in that example, it's not that reputation risk is doing any of the regulatory or punishment lifting. Right?
Yeah.
The reason that we're punishing Wells Fargo is because it was illegal to open those accounts, not because we think it just hurt their reputation. And so we saw the same thing in a bunch of money laundering orders. The regulator would say, stop laundering money. People are going to find out about it and they'll think that that's bad.
Yeah.
But it's difficult. So I don't think that in lots of instances, the reputation risk is really doing any of the regulatory or supervisory lifting. It's just there to remind banks that it's in their interest lots of times to follow the law or to do the things that are prescribed by the statute or regulation.
Well, one thing that's really interesting about that, I think that's a really great point, is just I was kind of thinking about, use Wells Fargo as an example, use any of the banks that have had these massive fines for money laundering. Does it really change consumers' attitudes or customers' attitudes or even stockholders' attitudes about this stuff? Like that, I guess the thing I'm trying to get at, Julie, and I'd love your sort of critical take on this, is a lot of the other things that you mentioned about what comes up in supervisory exams, ways to sort of assess safety and soundness, like even operational risk, which in the 90s was probably a kind of a squishy topic. It's become less squishy over time, right? Especially as banking has become digital and run on
cyber
computers
risk and like CrowdStrike and all these kind of ways.
There's ways of like assessing, like operational risk in a more sort of quantifiable or at least sort of like concrete way. Reputation risk, though, still seems as squishy to me as ever. Like how would you define, particularly if you were thinking about reputation risk, not as like a sort of thing that happens after the fact, like, oh, you did a bad thing and it also hurt your reputation, that's bad. But like, you're doing a thing, this might hurt your reputation. Watch out.
Yeah, you're doing something that people might not like, and it
like,
might
how do you evaluate?
It's the people whose opinion should matter.
Like how do regulators put themselves in the shoes of like, we think people you do business with might not like this, and therefore it's a risk. Can you kind of talk us through the thought process behind that? Because it doesn't make a lot of sense to me.
Yeah, so I think that you've kind of hit on one of the difficulties with regulating reputation risk. And it's that bank examiners, bank regulators, bank supervisors are not particularly well positioned to assess the reputation risk of any individual bank. So at least when reputation risk is happening just by itself, as opposed to reputation risk coupled with some other illegal or very risky activity. So, it might be that if you have an account for someone that is very controversial, that your customers hear about it and that they decide they don't want to bank with you anymore. But that's a lot of it might be's, right? Because bank depositors are notoriously sticky. Even in the Wells Fargo instance, after people learned that Wells Fargo has opened unauthorized accounts in their name, a huge portion of those customers still did not leave Wells Fargo.
Yeah.
And so to say, even when the bank treats you personally poorly, you don't leave. But we think that if you hear about something bad at another or another customer you don't like, you're going to move. Like that's very difficult. And it becomes even more problematic because regulatory descriptions of reputation risk are even more broad than you might anticipate. For example, one of the regulators said reputation risk is any risk of negative publicity, whether true or not. So now you've got regulators
rumors
to find out when there will be untrue rumors about a bank and shut that down. That just seems like if regulators are really this good at predicting the future, what we should do is we should send them all to Las Vegas, let them play the casinos, and then we don't have to pay taxes anymore. We can just live off the earnings there. I just think it's very hard. And I think I think banks find themselves in a very precarious situation trying to assess their own reputation. I've separately argued that banks ought not get into political controversies unrelated to banking simply because it's so hard to predict what your depositors will want, what your customers want, what your employees want, what your investors want, and that might not be the same for all of those groups. And so I think that risk minimizing bankers do well to try to stay away from political issues that are separate and apart from banking. But I think, for regulators to try to assess any particular action at a bank that doesn't have a clear financial impact and predict the future and potential impact of that it is very, very difficult.
So I need to say everything that I'm saying here is my thoughts, judgments, or opinions. They're not necessarily shared by my employer. And I have to say that because this really picks up on a...
Yeah, Julie too.
You're a law professor. You understand. This picks up on a thread that I've been thinking a lot about, which is who gets to run a bank and who gets to decide things like what risks you take, or who is a customer of a bank, or who should buy a bank, right? That there's a lot of kind of some negotiations, external negotiations that come up in deals. So I think about that a lot. And reputation risk, back to Sotomayor's question, does reputation risk, if it exists? We know reputations exist. We know banks care about their reputation. And when I think about who gets to take risks, I think a question that I came up with when I was reading your paper was, if reputation risk does exist, why can't a bank decide to take risk on its reputation? Why is that? I think one of the things that I was picking up on is that you shouldn't take reputation risk versus you can take risks that you decide to manage. So if you want to bank certain customers, why isn't that? And they might have a reputation that might extend to your decision to provide financial services to them. Why isn't that a valid business-based decision that a bank should be able to take? And then separately, it's not clear to me, and I don't think regulators have articulated, why should a regulator care more about bank reputation risk than an individual bank does? I guess maybe if the risk becomes systemic, there's a concern that one bank can be seen as risky, but when all the banks are seen as risky, now regulators feel like they've got legitimacy in providing feedback on it. So can you talk a little bit about this idea that I guess it's more about the agency that banks have to determine how they take risks, and that can be with reputation, it can be with customers.
So bank regulators say that reputation risk exists in every aspect of your banking operation. And that's probably true. Banking is by its nature risky. And I'm sure you've heard the saying, you can make some of the people happy some of the time, but you can't make all of the people happy all of the time.
Sure.
So, here's an interesting example. Here at the University of Wyoming, we just completed a 20,000 square foot addition to the law school. And part of the walls in the new law school were painted what I'm told is a Daphne blue color. Of course, the University of Wyoming's colors are brown and gold. And not everybody thought that the Daphne blue color was an appropriate color for the University of Wyoming College of Law. So anyway, it's getting repainted. But so even the paint color that a bank picks for its lobby might pose some reputation risk if you're defining reputation risk to be any negative publicity. And there is not a single decision that you can make that is never, ever going to make any person unhappy with you. Yeah. And so, of course, banks have to make these decisions, as does any other business, right? You have to decide how many times am I going to shovel the walk in front of the building? If I don't shovel it enough, someone might slip, and that'd be, reputationally bad if everybody finds out we have a slick sidewalk. But, I probably can't have someone out there 24 hours a day shoveling it. That's a decision about reputation risk. And some of those decisions are made by people making just over a minimum wage. And some of those decisions are made by a manager. Some of those decisions are made in the C-suite. Some of those decisions are made in the board meetings. But almost any decision you make at a bank could be reframed as a reputation risk assessment.
So the other thing that this, I kind of tying it back to the sort of Andreessen Rogan firestorm that sort of started at least on Bank Nerd Twitter. I guess the thing I'm curious about, and I'd love your take on, Julia, is there is, I think, this really hard problem where we have to sort of separate why things are happening, right? And so in the case of certain high risk industries like cannabis or like crypto or, adult services or any of these sort of like higher risk industries, it is really tricky, right? Because there probably is some form of reputational risk lurking there, right? And I think like in the context of like a high rate of like chargebacks happening in certain verticals, right? Where it's like a whole large number of customers are unhappy and they're charging back or they're falling victim to fraud or to scams. Like if you are the financial services institution that is facilitating that activity, there, I guess, arguably there is some form of amorphous reputational risk lurking there. There's also, to your earlier point, like actual more real risks and problems that are more in the sort of domain of what we've traditionally handled through bank supervision. And then I guess this idea that like reputation risk can sort of spread to like an entire industry or entire vertical. And so I want to get your take on when you look at some of the theories, I guess, that are out there about the debanking of entire industries or entire verticals. How do you see that sort of splitting out between like legitimate risk management concerns about, customer liquidity, fraud, scams, all of the things that, sort of traditionally within the realm of bank supervision, AML, yeah, like all of these things that are very real concerns versus reputation risk, and like how do you sort of parse out the division there between those two things?
So when a bank decides to close a customer's account, the customer is typically given a letter that says, we are closing your account, period. And so the customer doesn't know the reasons why the bank decided to close the account. The only people who know the reasons are the bank and possibly the bank's supervisor. And so for the customer and reporters and academics, it's very hard to figure out why it is that debanking happened in a lot of instances. So let's talk for just a second about what the possibilities might be. One possibility might be that the bank decided that they couldn't make any money on that customer, that the customer was losing them money. And that could be because there are lots of chargebacks. It could be because the account's overdrawn. It could be because to do the due diligence required to make sure that they're complying with the law, it's just so costly that they can't make a profit. I think that's part of what you're seeing in the marijuana space, right? It's just so expensive to do all that due diligence and all those SAR reportings that banks just decide they just can't do it. So that might be one reason. It's just not economical to have that account. Another reason that a bank might decide to close the account is because they think that the use of the account is violating the law. So they think that it's not compliant with AML or that they're unable to do sufficient KYC to make it compliant. And so they feel like they have to close the account based on the law. Another reason a bank might decide to close the account is just because they don't like the customer. The customer comes in and is nasty to the branch employees.
I can't believe that you would say that a bank just doesn't want this person as a customer.
Right. So they just don't want them around. Another reason that a bank might decide to close an account is because their bank examiner told them that they needed to. And the bank examiner might tell them that they needed to for a whole variety of reasons. They might tell them that they need to because the account is not compliant with the law, or they might tell them they have to close the account because the regulator doesn't like what business they're in, or they might, maybe the regulator just doesn't like that particular customer for some reason.
Right.
But from the outside looking in, it's impossible in almost all cases for us to say which of those reasons led to the debanking. And so this is part of why you see Mark Andreessen's comments having so many concepts mixed together, because all of those concepts sort of individually might lead to debanking, right?
Sure.
Like maybe it's just somebody has political hate. Maybe it's anti-money laundering concerns. Maybe it's a whole industry concerns. And I think this is also why you see such polarized commentary on this topic. So on the one hand, you see lots of comments that say, these are right-wing conspiracy theories. A regulator would never pressure a bank to close account based only on politics. And on the other hand, you see whole industries saying, no, we are not doing illegal things and we are not excessively risky. And yet they're still closing our accounts because they just hate us. I mean, the reason that both of those narratives are gaining steam at the same time is because from the outside looking in, the bank doesn't have to say why they're closing the account. All of the conversations within the bank would be confidential. And if there are conversations between the bank and its examiners and regulators, all those would be protected confidential supervisory information. So you think about the instances of debanking based on reputation risk driven by the government that we know about. That's Operation Choke Point. I guess we're calling it Operation Choke Point 1.0 now, but that's
we're not. No, we're not calling it that.
Well, some people are calling it that. But that's what the regulators called it. That's what they dubbed it, and they just pressured banks to not do business with payday lenders because they didn't like the payday lending industry. But the reason we know about that is because there was a congressional investigation after there were a bunch of rumors that were more or less denied. And the reason that we know about the New York Department of Financial Services is because they were dumb enough to say the quiet part out loud, to have a big press release. And so I think that this secrecy combined with these two kind of big reputation risk instances leads people to think, well, this might just be the tip of the iceberg. Maybe this is what happened to me. And everybody, of course, wants to believe that somebody hates them for some.
Everyone wants to believe it's a conspiracy.
Everybody wants to believe it's a conspiracy against them. They don't want to believe that it's something they've done wrong.
Sorry, your bank actually just doesn't like you.
Or you're not profitable to bank. Like that's such a, it's a really great point. You did a great job outlining that because I think, obviously, as with everything, the truth is always somewhere in the middle of these things. But you're right about this shroud of secrecy making it really hard to parse because and I'll just use crypto as the example. And I don't have to be as careful in saying I don't speak for my employer because I do speak for my employer. But the thing I think is interesting about the crypto space is I think a whole bunch of things can be true at the same time, right? In 2022 and 2023, when the bottom sort of fell out of the market and we're dealing with kind of these big public crashes in crypto, I think it's very reasonable to say, this isn't the most attractive space to bank at the moment. It's not that profitable. There is a lot of work and expense that has to go into doing this safely. There are concerns about money laundering. I don't really like people with laser eyes in their profile. I don't really understand them. They seem weird. I don't necessarily want to bank them. And they're not really favored by regulators, right? And I think that's probably a fair statement to make as well. And so these things all kind of get mixed together. And Julie, to your point, it's an excellent recipe for a conspiracy theory, even though I think there's very logical reasons to assume, for the most part, it's also not a conspiracy. So maybe asking another question as we sort of try to land the plane on this whole big sort of messy topic, maybe relating specifically to confidential supervisory information. A thing I'm really curious about is there any way to like fix this or make this better moving forward? Because I know that obviously confidential supervisory information, that designation exists for a reason. There are, as you illustrated before, very real concerns that are unique to banks around panic, bank runs, contagion, all of these things. So I understand the sort of impetus for confidentiality. It does seem like excessive confidentiality creates, in some cases, other problems that we might not always necessarily need. So do you have any thoughts on like ways to maybe change things moving forward that might make this better? Or is this always just going to be like a shroud of secrecy that's going to create these kind of problems?
Well, so I think that there are several places you could think about having a little less secrecy. So in the lending context, when people were concerned that banks were denying some customers credit for reasons that they shouldn't, because they were discriminating, one of the legal remedies for that was to require banks to provide some reason why they denied the credit. So if they denied
Adverse
the
action,
loan because the appraisal for the house was too low, banks are now supposed to tell the customer that, so that the customer can make an assessment for themselves of whether that was pretext or whether that was just the bank looking out for its financial interests. And so one possible way that we could get a little more transparency on this is that we could tell banks, if you're going to close an account, you got to provide some reason for that. I know that in the AML context, regulators have been very hesitant to want banks to provide any information.
I think it's part of law enforcement, right? These might be active investigations.
They might be active investigations. And
so we don't know.
You're going to tip them off.
And
I would feel better about that if I really thought that every SAR was leading to some active investigation. But really what's happening to all these suspicious activity reports is they're being stored forever and ever in some retrievable fashion, I guess, but not really investigated. So, and if you're closing the account, maybe we could say something about that. And, you could put in that law if you wanted that the bank has to say whether they did it on their own or at the direction of their regulator.
It's also, I think about, we don't have data on like how many people have lost bank accounts. We don't even have like demographic information. We don't have what banks these are happening at. We don't have, so in Nashville, there's a city councilwoman who is a person of color. And she is not, she might not be Christian, and she lost her bank account and she had several businesses. And so I think she had like multiple accounts at this regional bank that closed. And so she wrote, there's an article in the newspaper about that. And I would actually just like to know, when we think about the CFPB and CRA and HMDA and all these data about borrowers or the small businesses that are getting reported, do we have information about reported about who loses financial services and what industries they might be in? And, I know there's 4,000 banks. This would be kind of a reporting nightmare. But there's like, would it hurt us to know, is it mostly people who work in venture funded industries? Is it mostly, people of color who tend to overdraw their accounts, right? We actually do know from the FDIC that most of America says they have a bank account. And so we're talking about a pretty small group of people who, report not having access to a bank account, but maybe don't report losing a bank account. We just don't have the information.
Yeah, it's a data problem.
And so, we are kind of like, screaming into the void when we think about debanking. When I had heard about debanking prior to this, it was people who overdraw their bank accounts. And there were groups that were arguing this had, potentially racial implications based on things that have almost nothing to do with the bank account itself and have everything to do with the socioeconomic situations that these depositors are in. And they said, what I learned from this coverage was that banks were putting these people's names on a list, and so they couldn't get accounts elsewhere because they were seen as bad deposit customers or abusing the deposit
closed
account.
for cause databases.
Yeah, and so it's kind of hard for me to kind of say like these are the same. These are the people that are in the same groups. These debanked, and I just have no idea because we don't have that information.
Yeah, so there is it's called Checks.
Oh, right. Yeah, that's what it's called.
It's owned by Early Warning Services, who also created Zelle. Yeah.
Right.
It's owned by the big banks.
And I think that the idea there is not necessarily a bad one, right? If one bank loses money due to check kiting or overdrawn accounts, I mean, it seems sort of polite to let other banks know that if you open an account for this individual, you got to really be on top of it because it might lead to financial loss.
Well, and we do it in lending, to your point earlier, right? Like that's what the credit bureaus are.
So, I mean, my experience with the checks system is not just a bunch of banks who don't like customers putting them on this closed for cause list, that it relates to financial loss. But it's certainly true that there might be accounts closed that are not reported to checks because they weren't related to financial loss. And it's certainly true we don't have any data about that or way to sort that out at the moment.
One of the things that I've been thinking about with debanking, and it comes up in a couple of other places, is that access to financial services in the United States is sometimes a right and it's sometimes a privilege. And when we talk about debanking, it's a little closer to the privilege. But I think sometimes, we have seen movements to try to make it closer to a right. But at the same time, we don't have public or postal banking, so it's still not fully a public right. And so I always think that there's this kind of like public-private nature, which makes it that sometimes some people get to have it and they can maybe have a deposit account, but they can't have a loan, or they can't have a loan at certain interest rates. And then we have things like the CRA, which tries to make it closer to maybe a right. And so I think that I think that there's just always going to be a value judgment around who gets to have access to the financial system. Why is that important when the New York DFS tells banks not to work with the NRA because of reputation risk? It's not just because of reputation risk. They are trying to do something to the NRA under the guise that they do not have the privilege of access to financial services. And that would have further consequences for individuals that lose this access, right? And I just think that's, I think, you can call balls and strikes. You can hit singles and doubles. But the question is like, who gets to decide who's in the financial services system and who gets to decide why they should either not be at this bank or why they shouldn't be in the system at all?
Yeah, so I think if we think that people are getting their account closed just because one particular bank doesn't like them, but they're not a particular financial risk, we take comfort in the fact that we've got 4,000 banks, and I feel duty-bound to mention that there are also alternative financial providers known as credit unions, and there are also a number of those. And in the day and age of the internet, you can almost do business with a financial institution anywhere. So if it's just about someone at a particular bank doesn't like you, there should be other options for you. And so in that case, if the sandwich shop doesn't want to serve you a sandwich, maybe you can go to the next door sandwich shop. And maybe we don't, maybe we feel bad about that because it's inefficient, but it's also probably not one of the gravest problems facing America today.
Right.
The much more difficult question is when you get to people or industries that nobody will serve, right? Who do we decide doesn't deserve an account at any one of these
Yeah.
8,000 financial institutions. Because
Yeah.
if you don't have access to banking, you functionally don't have access to money.
Right.
And if you don't have access to money, if you're a business, you're not a going concern. And if you're an individual, you just have a very miserable life.
Yeah.
So that's a very precarious and unpleasant place to be in. And you can understand why, if people start to feel like they're in that position or are in danger of becoming in that position, why they get very nervous about the concept of debanking. If they think, well, my account got closed and those people are jerks and I'm just moving to a different bank and there's no trouble with that, I think most people will just move on with their life. But if they go to 20 or 30 or 40 or 50 or 100 banks and nobody will do business with them, you can see why that is something that you want to rant about on Joe Rogan.
Well, can I transition us from the debanking to the enforced have to banking conversation?
Yeah, because this is, speaking of Joe Rogan rants, I guess it's a mark of the times we live in that a rant on a podcast can trigger quite a bit of action on Capitol Hill. But yeah, tell us what's going on as it relates to sort of this fair access conversation, Kiah.
This is very unusual for us that we are talking about something that's like kind of in the news, and
this is breaking news this morning.
Who would record after this news. But today, in today's Morning Money, which will be last week's Morning Money when this comes out, there was the lead item was the interest from congressional Republicans to revive the federal fair access regulation that would prescribe when banks can decline to serve certain customers. So this would be a law that would tell banks when they have to serve certain customers and make it more explicit. And I guess my read is that it would take some of the judgment from banks about whether they want to serve certain customers or how much work they want to do to bank certain customers. Something that's really interesting is I was reading this as if it was a new item, and I was kind of surprised to learn that in 2020, this was one of the last pieces of legislation that passed. Like it legit passed. Like it was legit rule, and then it got CRA'd, or Congressional Review Act, under Biden. So this was 2020. Maybe there was something a little bit more important that was happening in 2020. So that's maybe why I forgot about it.
Yeah.
But I was surprised to learn at the time of the first Fair Access 1.0 bill that banks were opposed to this rule. They didn't want to be told by Congress who they have to serve. And there is a question now about whether that same opposition would exist because not because of debanking per se, but because there are state laws that are coming out that make it difficult, make it a little uneven for banks that are active in a lot of states to figure out what laws they need to follow. And then, there are some, so the question is, to me, like, banks don't want regulators to tell them who to bank or not bank. Do they want Congress to tell them who to bank or not bank?
Yeah, I think, Julie, we were talking about this before we recorded, but you sort of outlined there's almost two sort of dueling philosophies here. Can you kind of outline the thinking on this?
So again, I think it goes back to your inclination of why it is people are getting debanked. So if you think that it's the banks that are making the decision to shut out certain customers, maybe because they're, in the case of crypto or fintech, because they're worried about competitors getting too much power, then you tend to have kind of this populist instinct that the way to fix that is for Congress to pass a rule that says banks have to provide fair access to everyone, and regulators are going to police that. They're going to make sure that you're giving everybody a fair shot at these bank accounts.
Yep.
And banks might be nervous about that because it's difficult to draw that law in a way that still gives banks flexibility to close accounts that are not financially viable.
Mm-hmm.
And so that's kind of why you see pushback from banks. But that approach makes some amount of sense if you think the reason that people are getting debanked is because banks are cutting off access. And maybe they're doing it in the case of crypto or fintech because they're worried about competition.
Yeah.
But then I think there's another impulse or worry, and that's that debanking is really being driven by regulators and examiners that just don't like particular industries or have an overly broad view of their power to regulate reputation risk, or the people who just don't like Melania and Barron Trump and are making banks close their bank accounts, right?
Mm-hmm.
So if you think that the problem is that the government is choosing political winners and losers, untethered from risk, then you tend to think that the policy prescription to get rid of that is to limit bank regulators' authority. So you see proposals to cut back reputation risk. You see proposals that say, guidance is just guidance, it's not binding. And you see proposals to more clearly state that crypto is not excessively risky, right? And so, again, like all of this goes back to we really don't know why exactly debanking is happening. Instead, we just have people who have very strong opinions about why it's happening.
We don't know why it's happening, but let's pass a law about it.
And the only place to get information is to ask the regulator, who are incentivized to say, it's not us, don't blame us.
Right.
And banks who are incentivized to say, of course we didn't do anything wrong.
It's a hot potato, man.
Right. The thing I was going to say just about the two sort of dueling philosophies here is, again, like the truth is always somewhere in the middle. I do find the idea, going back to your point, Julie, about like competition and there being 4,000 banks, credit unions, all these different groups. Like, I'll just use fintech as the example. I've seen fintech sort of get lumped in and banking as a service as like a part of this argument around debanking. And having paid very close attention to that space over the last couple of years, I can tell you there are banks that absolutely want to do that, right? So like that's not a market-driven thing where banks are going, yeah, we're worried about fintech companies. Like big banks feel that way. Small banks are like, great, we'd love to partner with fintech companies. And so I do think this idea of like trying to strike a balance between not having regulators have sort of an excessive ability to weigh in on things that are sort of outside of their core safety and soundness areas. And this, of course, ties back to reputation risk versus sort of enabling market competition to just sort of do what it does, right? Not everyone's going to want to bank cannabis, but for those that do, they can. I wrote about in my newsletter that OnlyFans, which has grown tremendously by featuring sexually explicit content, they briefly went through a phase where they were going to maybe have to stop doing that because there was this worry about getting debanked. But largely, I would imagine because their business is growing so fast and it's attractive, somebody was willing to continue to bank them and was able to they were able to solve that problem and not have to make that change to their platform. So this balance between allowing market competition to like draw banks to serve even high risk industries while also sort of trying to prevent regulators from excessively weighing in on areas that don't affect safety and soundness, it's a really tough policy prescription to your point. And I think the other thing that occurs to me around a lot of this stuff is just, and this is a point that I think has come up recently. I saw an interesting op-ed about this. There also needs to maybe be slightly more tolerance for banks failing, I think, is the other part of this a little bit. And this ties back to, Julie, what you were saying before, where it's like, we're so worried about this bank failing, and then if it fails, there's going to be a contagion and everyone's going to freak out. And we went through this whole thing with Silicon Valley Bank. And I think that maybe some of those concerns do get a little bit blown out of proportion. And a healthy part of the market needs to be, it's okay for banks to take on risk and even like reputational risk and fail and not have worries about that spreading into a contagion that takes down the whole financial industry. Again, I know that's not the incentive that prudential regulators have, but it feels like that's not totally an unreasonable thing to say.
Yeah, I mean, I think that the trouble with a regulator taking the position, a failure every now and then is good for us.
Right. Not their job to say that. No.
Right. Is that regulators tend to take a reputational hit themselves when there's a bank failure. Right. So it's always, why didn't the regulators catch this before? And why did the regulators allow this to happen? And so even if we don't see clear contagion from the failure of an individual bank, I do worry that over time, if the public doesn't think that regulators are ensuring safety and soundness of every bank, particularly where deposit insurance is not, complete. Then I do worry that over time, if you had a significant number of bank failures, you could have a situation where the reputation of the regulators takes such a hit that it leads to banking problems.
Right.
I think, going back a little bit to reputation risk and regulatory focus on it, as someone who had, as part of the bullying campaign to make the BSCA a thing, I think a little bit about, where did regulators spend their time? And where did they spend their, when they went into banks, where did they spend their time thinking about? And the BSCA is a law from Congress. They have, and I think that as I try to figure out, what powers do regulators have and how have they used those powers, I think if was there, and I was reading your article about how reputation risk was infused and appeared in their guidance documents and in their exam manuals. And then that became like a box that they could, or like grounds for exam, supervisory feedback. I think there's just this thing about, that they decided reputation risk was really important and then directed some energy there. But that cost them, what that cost them was focus on maybe third-party risk. And then now we live in this world where I see a lot of third-party risk and I see third-party risk causing reputation risk.
Right.
And and that I actually think there was, based on the existence of this law, a place where regulators could have put a stake in the ground and said, we have legitimacy and authority to examine banks or their third-party partners that provide them bank services.
Mm-hmm.
And they didn't, and they focused on reputation risk. And then what did that buy the industry? SVB and First Republic had good reputations and failed when those reputations changed. And then the other thing too is I think there's some rightfully, if you are going to tell other institutions how to manage their reputation, you better make sure you have a good reputation yourself. And to your point about too many bank failures, that could come back on the regulator, but the regulators themselves have bought some trouble with their reputations for conduct that they themselves should be held accountable for, right? So, I wonder the legitimacy and the credibility of such criticism of, think about how people will talk about your institution. Start with your institute, certain regulators, start with you first, and then you can tell me, a bank, how I should be thinking about my reputation. If some news stories got published about what kind of a workplace I run, I think that, your paper ends in 2019, but there's so much fodder in 2024 that I think that, this deserves an update.
So we should never pass on the opportunity to point out that bank regulators should have a safe and honest working environment.
Yes.
That is free from sexual harassment. This is just something
that's the minimum, the bare minimum right there.
And I think that one of the things that sometimes gets missed in that is if FDIC supervisors treat employees at the FDIC like that, how do you think they treat the employees at the banks where they're examining? Who have even less power than employees within the FDIC. And I haven't heard a lot of commentary on that, but I think that that's probably something that the FDIC should examine going forward. Because banks also deserve to be, and their employees deserve to be treated with respect and as professionals. Mm-hmm. But, I'm also somewhat, a tiny bit sympathetic to bank regulators in the aftermath of Operation Choke Point, because I think that there was some realization that the things that they do have a reputational impact on themselves. And so I think that there was a push to try to bring transparency and clarity to the banks that they regulate. I don't think that it went entirely there. I think that there's more work to be done on that. And it's sort of interesting to me to think about how a new administration could appoint top-level administrators that could kind of change a bit of the culture and focus of really large institutions. So I think that that'll be a challenge going forward. But, it's just, I don't think that, I think most regulators are hardworking and trying to do a good job. And I think most bankers are hardworking and trying to do a good job. So I'm hopeful that as this debanking issue receives more scrutiny, that these very reasonable, hardworking people will take a clear look at what can be done to make the situation better. And they only have so many hours in a day. Yeah. And so I think that really someone that comes in and looks at these problems afresh would be well suited to say, what is the core competency of bank examiners and bank regulators? And I think that the first two things on that list have to be the safety and soundness items that were considered before the 1990s. It has to be that the primary focus of the regulators are credit risk and market risk. And that's part of what got lost in Silicon Valley Bank, is that we got to make sure that these two huge risks are managed appropriately. And then we can talk about what other management of risks are nice to have and reduce friction and help people and all of that.
Yeah.
That is a perfect note to leave it on, because I think you put an excellent bow on the topic, Julie. Thank you for having a nuanced and very sort of grounded in data and research and facts conversation with us on this topic. I hope we can put this podcast out into the ether and have it sort of contribute to this discussion. Julie, the returning champion to the Bank Nerd Corner podcast, thank you so much for taking the time. We'll have you back again.
Thanks. I look forward to it.
All right.
Thanks, Julie.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.